Thank you, Kajal Madam, for your kind words and that introduction. Happy afternoon to each one of you. Good afternoon to each one of you. And first of all, I convey my compliments to each one of you for joining this program. And I also thank the organizers of this Divya Jyoti Foundation, who has provided me this great opportunity of having interaction with each one of you. This will we will make it a kind of a knowledge sharing session. In valuer profession, registered valuer profession, as we all are aware, it is a very challenging task that we come across. And one of the tasks is a selection of appropriate valuation approach and followed by technique of valuation. So valuation approach, as we are aware, worldwide three valuation approaches which are recognized. That is MIC or market, income and cost. So cost approach, it is a sort of residual approach, and it is used only in exceptional cases, not as a primary basis of valuation. As per an estimate, actually, world over around 70 to 80%, or perhaps more than that. Those valuation estimation is done through the market approach. Primary method of market approach is recognized widely, not only in India, but at a global stage also. And that in a way is true, because what ultimately a price prevailing in the market, that will always have a upper hand. Because we can take an example of our personal life also. Supposing we are residing in a rented premises, and we want to move to our own house. So there actually necessarily first we will have to ascertain the budget, and then we will have to fix some locality or zero down a certain locality, and then we will ascertain the price. So whatever price is prevailing there, we will have a very little scope in negotiating that price. Now, if I arrive at my price through the income approach, that is through a saving of rental, then that perhaps may not be accepted by the counterparty. So that is the reason in a field of valuation also, means majority of the valuation estimation is done through the market approach as a primary base, and income approach is taken as the secondary base, because whatever valuation estimation is arrived through market approach, a valuer would always like to cross check it, because whatever estimation is arrived, that many uncertainty will be there. So a valuer need to satisfy himself whether that estimate is correct or not. So there actually this income approach is used as a secondary mean. And as we are aware, the international valuation standard. So we are presently doing a valuation as per the international valuation standard. So international valuation standards were last revised effective from 31st of January 2022. That is the first month of current calendar year. So there actually a fourth approach. If you go through the documents, you will find prior to that amendment in the international valuation standard, a discussion paper was circulated by the council, that is International Valuation Standard Council. In that actually fourth standard or fourth approach in the form of a hybrid approach was proposed. But once the suggestion which were received by the from the stakeholder, idea of having a fourth valuation approach was dropped. So at present, we have a three valuation approach: market income and cost, or MIC, or kal aaj or kal. We can also call it as yesterday, today, and tomorrow, because whatever cost is there, that is a thing of the past. So that is related to yesterday. What price is prevailing in the market, so that is a thing of today. And what income will be earned, so that is a thing of the future. So MIC, or kal aaj or kal, or yesterday, today, or tomorrow, whichever way we may remember. But these three approaches are recognized not only in India, but world over. Means under these three approaches, under these three valuation approaches, there are a number of valuation methods, and there are a number of techniques which are recognized under the international valuation standard. And it is also specifically mentioned in IVS that these methods are mentioned as a illustrative purpose only. So these list of method which are recognized under IVS, under these three approach, these are just for illustration purpose. That list is not exhaustive. So any other method apart from what is mentioned under the IVS, a valuer can devise other evaluation method also, or he can take help of other evaluation method also. So that is the brief about this our today's topic. And now, since the time is limited, just 2 hours or 120 minutes or so, so I will directly go to my PPT, because the valuation approach and valuation method is the subject we can discuss for hours together. And we all are aware, as I told you, market approach is the most accepted approach. But valuer actually, that market approach is a relative approach. So a valuer needs to compare a subject asset or subject company with the similar company at the marketplace. Now there actually it is most challenging. It is recognized world over. And in India, we face another challenge also. Because what is reflected in the financial statement, that may not give the true picture of the subject company or the subject asset. So we all are familiar about the transactions which are taking place, so no need of explaining that. So there also a valuer actually faces many challenges, because whatever estimation is arrived at, it is always means the client is not satisfied with that. He always would like to have a higher value of his company or his asset, which is not again reflected in the financial statements. And financial statement, that is the benchmark for a valuer, particularly when he is accomplishing the valuation as per the DCF method. So that is the reality, and each profession will have its own challenges. It is not that only the valuation profession has the challenges. So we have to deal with that, and no other alternative. So that is a part of our professional life. So I will now share my presentation. So I hope my PPT is visible to each one of you. May I request one of you to please confirm that?
Yes, sir.
Yes,
it is
yes,
audible.
yes, sir.
Visible and visible.
Yes, sir. Yes, sir. It is visible.
Okay,
Visible.
thank you very
Visible,
much
sir.
for
Visible,
that.
sir.
Thank you very much for that confirmation. So looking at your reaction, I actually confident that we will have a great session today, a great interactive session today. So what I will do, theory we can discuss, and we all are registered valuer now. So we all are aware about the theory aspect. So I will actually start with practical examples, because that is what matters. So I will start with these findings of a survey. So you may be aware this NSE or a National Stock Exchange and EY. So there is two institutions. They have jointly conducted one survey which is known as Cost of Capital Survey, India Specific or India Insight 2021. So means this survey document is available on the internet. Some of you may have come across this survey. So in this survey, what I find actually important findings from the respondent of this survey is given. So that is actually I would like to highlight that first. So first is relating to basis of cost of equity. So whenever we are doing a valuation as per a DCF or income approach, first thing is which cost of capital or what rate of discounting should be considered in that method. So the findings of this particular survey is most companies that is greater than 50% prefer using an organization specific hurdle rate. So that we have to actually normally we arrive at the cost of capital through CAPM, that is capital asset pricing model. But here in India, greater than 50%, they are going by the organization specific hurdle rate. So what is organization specific hurdle rate? So as we are aware in the capital budgeting decision, an organization fix certain hurdle rate. So beyond if the return from investment of that particular capital asset is more than that hurdle rate, then only company or a business entity will go ahead with the that project. So that is a hurdle rate. So each organization will have its own hurdle rate, which will be more than its IRR or internal rate of return. So they prefer going by that organization specific hurdle rate because you can arrive at the cost of equity through CAPM easily for the listed entity. But in case of non-listed entity, it will be very difficult to get the equity beta because what is the formula of CAPM? So formula of CAPM is risk-free rate plus beta into equity risk premium. So it is always difficult to arrive at the beta of non-listed entity. It is very easy to arrive at beta variable for the listed entity. So in India, actually greater than a 50% company, they prefer to use organization a specific hurdle rate as their cost of capital. And a little over one third, that is 33% of the respondent indicated that they use a CAPM approach, so capital asset pricing model, which is in contrast to the developed market of US and Europe, where the application of CAPM in a discount rate estimation is much more widespread. So we have to remember the developed country like USA or UK or European country or Singapore, they actually arrive at cost of capital through capital asset pricing model or a CAPM. So given the volatility seen in equity markets in the recent times, so this survey was conducted in 2021, and as we are aware, 2020 it was a year of COVID-19. So in a stock market, actually there were widespread volatility. So that is what is referred here. So volatility seen in equity markets in a recent time, the trend observed in the previous survey of using a bank lending rate with necessary adjustment continues to be a preferred benchmark for a cost of capital for nearly 20% of the respondent. So from these actually we can gather that there are different methods for arriving at cost of capital. Number one, it is CAPM, which is widely accepted in developed countries like US and all. Number two, it is organization specific hurdle rate. Number three, it is the bank rate. So these three are different rates which can be fixed for arriving at cost of capital. So use of a bank lending rate as a starting point for a discount rate estimation was absorbed predominantly in the FMCG, that is FMCG companies, that is fast moving consumer goods company, or a consulting company, or a healthcare company, or chemical company, or the retail sector. So this is very useful guidance. And once it is started with lending rate, bank lending rate, so then the depending upon the ground reality of each valuation assignment, the rate can be built upon. So cost of capital rate can be built upon, or discounting rate can be built upon. So as we are aware, there are two measures mainly. One is beta, another is alpha. So beta is relating to systematic risk, which is at a marketplace, and alpha is relating to company specific risk or entity specific risk. So whenever this bank lending rate is taken as the basis, then the measure of alpha will be added to that, and that is how cost of capital will be established. So that is the basis of estimating the cost of equity. Moving forward, what company specific factors are used to adjust cost of equity? So as per CAPM theory, which we all are aware, a formula is risk-free rate plus beta into equity risk premium. As per CAPM theory, the discount rate estimation, the risk that companies are faced with means broadly we put into two buckets. Number one, it is a systematic risk. Number two, it is unsystematic risk. So systematic risk of a company are dependent on the risk of overall market or industry, and can be eliminated by diversification of investment. However, the unsystematic risks that are specific to the company and not based on a factor that affect the overall market or even the industry. So therefore, unsystematic risk cannot be eliminated by a diversification. So that is a very important guidance which we get from the findings of this survey. Basically, there are types of risk: systematic risk, unsystematic risk. Systematic risks are relating to marketplace. Unsystematic risks are relating to company specifically. A measure of systematic risk is beta. A measure of unsystematic risk is alpha. So that we have to remember. And while systematic risks are represented by beta, which is part of discount rate estimation as per CAPM, unsystematic risks are represented by alpha. So there are various factors that could necessitate alpha adjustment, that is a company specific measure to the cost of capital. So respondent identified company project specific risk perceived at the time of evaluation as the biggest factor, followed by uncertainty stemming from conservativeness or the aggressiveness of in projection used in analysis. So whenever we get a projection from our client or from the side of management, so their priorities will be different. Like a startup company, their priority is to get maximum finance. So they will actually give a very high projection about income that their startup will earn. So that can be adjusted through alpha measure. That can be adjusted in this discount rate. So that is important guidance. Now moving forward, how do you use the DCF techniques to evaluate the investment opportunity? So where these DCF techniques are used. So about 62% of the respondent considered the DCF method in combination with other methods such as peer company multiple. So that is market approach and or a transaction multiple. So that is again a market approach. And only 20% of the respondent use a DCF analysis as the primary basis for making investment decision. So as I told you in the beginning itself, around 80% of the this valuation estimation are accomplished through use of a market approach as the primary approach. And this 20% respondent, according to this survey, they are going by DCF as their primary method. And these proportions are in line with the trends observed in 2017 survey. So these particular NSE, National Stock Exchange, and EY, they had conducted similar survey in 2017, and they had got similar trends in 17 as well. And reiterate that a combination of forward-looking scientific approach such as DCF along with empirical and relative market-based approaches seem to work best with the finance professional. So that is again a very important guidance. Now, what is the typical forecast period? So as we are aware, these projections are done in two different forecast period. Number one, it is explicit period. Number two, it is terminal value. So explicit period, if we go as per the guidance which is provided in Ind AS 113, that is Ind AS 113 is relating to the measurement of a fair value. So there specifically it is mentioned that the explicit period should be of 5 years, but it can be amended depending upon the ground reality of each case. So that is what should be a typical forecast period. So valuation using a DCF approach, it involves two components: a value of cash flow for the explicit forecast period and the terminal value of the cash flow. So explicit period is the period for which reasonably detailed forecast can be prepared, and more than half of the respondents showed a clear preference for considering explicit forecast period of 5 years for DCF analysis before applying the terminal value. But of the remaining responses, an equal proportion of participants, 20% each, around 20% each, showed a preference for 3 years and 10 years, while remaining for others. So bearing this 90%, that is 50% for 5 years, 20% each for 3 and 10 years. So remaining 10% are under other category. So they companies that make up others category would primarily be those that evaluate a finite lived project. So that are means the life of the project is fixed actually. So they use actual remaining project life as the forecast period. So we are aware, supposing we take example of renewable like wind or oil. So there actually project life is fixed. Supposing it is 20 year, it is 25 year. So no need of arriving at the terminal value. That project life is taken as the forecast period. So preference for a 5-year forecast period by the majority of respondents, it indicates that they typically consider these to be the period for which reliable estimate can be prepared with a reasonable basis. So that is what justification is. Moving forward, terminal value. So as we are aware in DCF, actually around 75% to 80% value, it is derived from the terminal value. So terminal value, it is an estimate of potential value that can be generated by the company or a project once it operates at stable level perpetually. So in most companies, the terminal or perpetuity value accounts for a large part of overall company value. And of the two most widely adopted approaches of estimating the terminal value, more survey respondents use the Gordon growth perpetuity model or the Gordon growth stable rate model than the exit multiple. So terminal value we can arrive at through several methods, but most accepted method is this Gordon growth model or a Gordon growth stable rate model or a Gordon growth perpetuity model. And exit multiple is also used. So like in the case of startups, when we arrive at the valuation of a startup entity through venture capital method, so there actually these exit multiples are taken in a majority of the cases. So respondent in sectors such as infrastructure or power and utilities and renewables indicated that since most projects are finite lived, so no terminal value is considered, while some of the respondents added that they use asset valuation, that is salvage value of asset, to arrive at the terminal value. So this is again a very important guidance relating to arriving at the terminal value, because terminal value is the most important component of valuation estimation when we do valuation going by DCF method. Now, terminal growth rate, again, this is a very important factor which needs to be considered. So generally, actually, if we go by the guidance which is provided in the International Valuation Standard or IVS, the terminal growth rate, it should be taken, it should not be more than the growth rate of a economy in which that particular company operates. So supposing it is an Indian company, so if you take average GDP growth rate of India for last 10 years or so, it is roughly around 5.5%. So that data you can get from the website of the World Bank. You will get reliable data from that. So that is around 5.5%. So that is the upper limit. So that terminal growth rate cannot be more than 5.5% for a Indian company, because that is the upper level. Because in a short run, a company may have a growth rate, abnormal growth rate like 10%, 20% or 30%. But this valuation is done in perpetuity. So in a longer period, the growth rate will ultimately be adjusted to the growth rate of the economy in which that company operates. So that is what is findings of this survey also. So terminal growth, it is the long-term stable growth rate at which a company estimates to grow beyond the explicit forecast period. And average long time stable growth rate for Indian businesses as suggested by the respondent is approximately 4%. So in 2021, average rate taken by Indian company was 4%, which again is less than the growth rate at which Indian GDP is progressing. And this is lower than 4.5% average observed in 17 edition of the survey. So that is what I wanted to highlight in the beginning. Now this document, that is a very useful document, and it is not actually appropriate to go through the entire document in a short session of 2 hours. So if you are interested, you may download this particular survey. It is freely available on the internet, and there apart from these useful guidelines are also, or useful findings are also incorporated in case of a startup and other important other important findings are also incorporated. So if you are interested, I suggest you may download that from the internet. Now, moving forward, before we actually move forward to our today's topic, valuation approaches. We will actually recap or revise. Actually, we all are aware about this, but we will revise the meaning of important terms. So, valuation approach. When we are talking about a valuation approach, so what exactly is the meaning of valuation approach? So, going by IVS or International Valuation Standard. Valuation approach in general, it is a way of estimating a value that employs one or more specific valuation methods. So that is what valuation approach is. And what is a valuation method? Because valuation method is a part of a valuation approach. So what exactly is the meaning of valuation method? So within valuation approaches, it is a specific way to estimate a value. So that is the simple meaning or a very easy to remember meanings of valuation approach and valuation methods, which are part of IVS. Moving forward, what exactly is the valuation? So we all are doing valuation. We are well familiar with it. So that is nothing but act or a process of determining an opinion or a conclusion of value of an asset on a stated basis of value at a specified date in compliance with the IBS. So stated basis is very important. So as we are aware, under IBS, there are 5 general standards which are applicable in case of all valuation assignment. And there are 8 asset standards which are actually applicable to the relevant assets. So as we are aware, in January 2022 version of IBS, a new asset standard for inventory is added. So now there are 8 asset standards. Earlier, there were 7 asset standard. So that is again a very important. That basis of value is very important, and premise of value, that is very important. So guidance on that is provided under IVS 104, how to ascertain basis of value and how to ascertain premise of value, and guidance on valuation approaches and valuation method, that is provided under IVS 105. Again, same meaning actually, as we are aware of this red book of valuation, which is published by this RICS red book. So there also a meaning of these approaches, these important terminology is given. So that is also very important. Here it is given in much more detail. So what is a valuation approaches? So it is the overall manner in which the valuation task is undertaken in order to determine the value of the particular asset or a liability. And term valuation method is generally used to refer the particular procedure or a technique used to assess or calculate the result. So that is the what elaborate meaning of the valuation approach according to this red book. So red book is also giving important guidance. Like that, there is a blue book which is published by the European countries. So that is also a very important valuation method. So according to this red book, the meaning of valuation method is valuation method may include a range of tools or techniques as well as different forms of modeling. So as we are aware, when we are doing valuation as per this DCF particularly, so there actually financial modeling is very important. So financial modeling in itself is a big subject whenever we are doing this valuation exercise. So that is what is referred the different forms of modeling, and many of which involve advanced numerical and statistical practices And in general, the more advanced the method, the greater the degree of vigilance needed to ensure there is no internal inconsistency. So we can take example in relation to assumptions adopted. So nowadays, as we are aware, there are a number of automated valuation model. So in automated valuation model, a valuer needs to input certain variable or certain information, an entire valuation report in the form of a PDF that will be provided by that automated valuation model. So there actually it is very important for a valuer to give the correct inputs. Otherwise, we are familiar with the garbage in, garbage out principle. So there actually it will be more than necessary. And in case of actually financial modeling also, it is very important to check the consistency of inputs and assumption. So these reminds me actually, if we want to go through the one sample of financial model, how it is prepared. So Aswasth Damodaran, as we are aware, Mr. Aswasth Damodaran, he is considered to be the valuation guru worldwide. So he had made one estimation in March 2022. He has developed entire financial model for a Twitter. So Twitter, as we are aware, Mr. Elon Musk, he had actually at that time he had come out with a proposal to acquire the Twitter. Then what happened in that case, and what is presently happening with Twitter. So we all are available. We all are aware about those developments. So on Twitter, actually, he has developed a financial model which is available on his blog or on his website, Twitter 2022. So that financial model actually that will provide very useful information. In a normal course, actually, we get that type of information by making payment of the subscription. It comes with a cost actually, but that is available free of cost on a website of Mr. Aswasth Damodaran. So if you are interested, I suggest you may download that financial model. So that will provide you a good outlook of valuation technique. Now, continuing with our definition, means meaning of important terms. So asset or assets means to assist in a readability of the standard and to avoid repetition. The word asset and asset referred generally to items that might be subject to a valuation engagement. So unless specified in the standard, these terms can be considered to mean asset or group of asset or liability or group of liability or a group of assets and liability. So in our traditional way, we understand asset as the resources for earning future revenue. But in a valuation assignment, it is not so as per meaning given in IVS. So asset will include liability also. So that is what I wanted to emphasize. And client, again, there is important change in the meaning of a client going by revised valuation standard or revised version of IVS. So client refers to the person or persons or entity for whom valuation is performed. So this may include external clients when a valuer is engaged by a third-party client, as well as internal client, that is a valuation performed for an employer. So going forward, the big companies like Reliance and Tata's can engage a registered valuer in-house for their valuation assignment. So that concept may come actually at present, like chartered accountants or post accountant or company secretary or engineer are engaged by a company. So a registered valuer can also be engaged. So that is new concept, and this revised definition of client is as per the latest version of IBS, that is IBS 2021. What is the intended use? So a use of valuers reported valuation or valuation review results as identified by the valuer based on communication with the client. And intended user, again, a very important. In each valuation report, we should make it a point to mention or indicate what is the intended use of that valuation report, and who are the intended user of that valuation report. But going forward, because going forward, if that valuation report is challenged, then these information which is incorporated in the valuation report, that will come to the rescue of RV. So here actually I would like to give one practical example of Kingfisher case. So as we are aware, actually, Kingfisher started its commercial operation somewhere in 2005, and it discontinued its commercial operation somewhere in 2012 because of its failure to make a repayment of a loan it borrowed from the banks and financial institutions, and other dues like employee dues, tax dues, etc. So there actually, perhaps for the first time and last time, the bankers or financial institutions in India, they had ventured to give finance or provide finance to the Kingfisher airline based on its brand value. So brand value actually was ascertained by a world-renowned valuation firm, and which was actually in thousands of crores rupees, and based on which finance was given. Now, once a company is closed down, what value of its brands will remain. So that actually, when investigations were made by the investigating agencies like CBI, as per the news report which are available in the public domain. So questions were asked to that valuation firm, how you have arrived at such a high brand value of this Kingfisher airline. And based on that, actually, nation has suffered the loss. So that valuation firm that openly told our valuation report was for the internal consumption, and that we have mentioned also our valuation report was never meant for a borrowing purpose, and that is mentioned specifically. So that is how it can be useful, or that is how it can save a valuer. So intended use and intended user, these are very important, and it should be mentioned in the valuation report invariably. Now, purpose means purpose refers to the reason a valuation is performed, and common purpose include, but it is not limited to financial reporting, tax reporting, litigation support, transaction support, and support of a secured lending decision. Subject or subject asset, we are familiar with that. These terms refer to the asset valued in particular valuation engagement. And value, again, it is opinion resulting from a valuation process that is compliant with the IBS. So that is very important. It should be compliant with the provisions of IBS. It is an estimate or either a most probable monetary consideration for an interest in an asset or the economic benefit of holding an interest in an asset or a stated basis of value. So now we will move valuation approaches and methods. So as we are aware, there are two types of standard under IBS. One is general standard, another is asset standard. So what exactly is the meaning of general standard? So these set forth requirement for conduct of all valuation assignment, including establishing the terms of a valuation engagement, basis of value, valuation approaches and methods, and reporting. So they are designed to be applicable to valuation of all types of asset and for any valuation purpose. So that is very important. General standard, general use. Asset standard, so that is include a requirement relating to specific types of asset, and these requirements must be followed in conjunction with the general standards when performing a valuation of a specific asset type. So asset standard include a certain background information on the characteristics of each asset type that influence value and additional asset specific requirement on a common valuation approaches and a method. So these are actually 5 general standards starting with IBS 101 and ending at IBS 105. So 101 is relating to scope of work, 102 investigating and compliance, 103 is relating to reporting, 104 relating to basis of value, and 105, which is our today's topic of discussion, valuation approaches and a method. So these are the general standard, and these are the asset standard under IBS. So as we can see, there are 8 asset standards starting with IBS 200 and ending at IBS 500. So IBS 200, it is relating to a business combination or merger and acquisition cases. So businesses and business interest. Intangible asset, again, another very important and challenging assignment for a registered valuer. So that is intangible asset, because as we are aware, world over, the value of undisclosed intangible asset in a financial statement is very high as compared to a disclosed value of both tangible and intangible asset. So very important valuation, a very challenging assignment for a valuer. 220, it is financial liability. 230, it is inventory. So inventory actually is, as I told you, that is added recently in January 2022 version of IBS. And inventory, as we are aware, it is one of the high value asset on the asset side of a company, and it is a major cost element in the income statement. So cost of goods sold or cost of service provided, that is always a high value or highest value cost element in the income statement of a company. So just for your information, how much value of inventory you can visualize of a company. So if you go through the financial statement of my past employer, that is Indian Oil Corporation Limited. So Indian Oil Corporation Limited was having a inventory of 1,10,000 crore plus as at the 31st March 2022. So that is the importance of inventory. It is a very high value for any company. Then plant and equipment, real property interest relating to real estate project. So IBS 400 is important for a real estate project. 410 development property and 500 financial instrument. So these are the valuation approaches we discussed. It is MIC or market income and cost approach. And what is market approach? What is income approach? What is cost approach? We all know about that, but just a brief recap of that. So a market approach, it provides an indication of value by comparing the asset with identical or a comparable asset for which price information is available. So each word of these guidance is very important. Number 1, it is identical. Number 2, it is comparable. And number 3, price information is available. So on a lighter side, in our real life, we always say the nature of even two brothers and sister is not the same. So how can we can get two companies which are of a comparable nature or a similar company? So that is the challenge of a valuer. That is where the challenge for a valuer comes into play. An income approach, so market approach, it is a relative valuation approach, relative technique. Income approach, it is absolute technique, absolute method of valuation. So under income approach, it provides indication of value by converting a future cash flow to a single value. And the cost approach, so it provides an indication of value using economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility. So that is the meaning of market income and cost approach. And these are the evaluation methods under IBS 105. So here actually, once again, I would emphasize that whatever methods are specified or recognized under these three approaches. So this list is not exhaustive. Apart from that, there can be many more methods. So under market approach, it is a comparable transaction method or a guideline transaction method. Second is a guideline publicly traded comparable method. And third is other market approach consideration. So under market approach, these other market consideration, so that actually is a majority of valuation are done through these other market consideration also, which include actually a rule of thumb, which include a discount for lack of marketability, which include a discount for a lack of control, which include a discount for a block deal. So all these other considerations come into play under this area. And rule of thumb, so as we are aware, presently the central government, it divested its share in LIC or life insurance company. So we are not aware exactly what the method was followed by LIC in evaluation of government stake, because that may be confidential. But as per the information which is available in a public domain, the rule of thumb, which is a market approach, that was followed in evaluation. So how that was followed? So that certain percentage of OM was taken as the valuation estimation. OM is nothing but asset under management. So as we are aware, LIC, it is collecting premium. So that is in a way asset for the company. So whatever was the OM, asset under management, so around 20 to 20% of that was taken as the valuation. Likewise, as we are aware, the central government, it has actually embarked on a mission of infrastructure development. So it is known as NIP or National Infrastructure Pipeline. So between 2020, between financial year 2020 to financial year 2025. So in these 5 years, a government has anticipated or estimated expenditure of 111 crore rupees, 111 lakh crore rupees on a development of infrastructure. So how it will be financed? It will be financed through various modes of financing. And one of them is monetization of assets. So whatever assets are there of a government, that will be monetized. Either it will be sold out or it will be means control will be kept with the government, but some kind of arrangement will be arrived at. So there actually a valuation is done through a rule of thumb. Like this one of the asset which is earmarked for this monetization, that is natural gas pipeline. So there actually government has adopted this rule of thumb like 3 crore rupees per kilometer of natural gas pipeline. So that is based on the past transaction of private past transaction. So that is how it is done. And this reminds me actually, Niti Aayog has published a report on these. And there, if you are interested, that also again, it is available on the internet, Niti Aayog report. So there actually, we may come across various methods of valuation that the government has actually adopted, because sizable assets have been proposed for monetization. So therefore, a different asset, a different valuation approach is adopted. So that Niti Aayog report is available on the internet. If you are interested, you may download that. Income approach, mainly it is a cash flow statement. But under income approach, as we are aware, this income capitalization methods are also widely used. So one of the example of income capitalization method is dividend discount method. So these type of methods are used under the income approach. And under cost approach, it is replacement cost, reproduction cost, and summation method. So we all are familiar with these type of methods. And this is actually a valuation and approach and valuation methods going by ICAI valuation standard 103, ICAI VS. It is not VA, it is a VS 103. Three approaches again: market, income, and cost. So under market approach, it is a market price method, comparable company method or CCM method, and a comparable transaction method or a CPM method. Under income approach, actually it is a discounted cash flow method, which is common, and this relief from royalty, multi-period excess earning method, and with and without method. So under IVS also these methods are there, but that is mentioned in the asset standard of intangible asset. Here it is mentioned in the IVS means 103, but there it is mentioned in the asset specific. So apart from these, under IVS, there are two other valuation method which are mentioned for intangible asset. That is greenfield method and this dealer means distributor method. So these are the methods specifically applicable in case of valuation of intangible asset. And option pricing method, so that is nothing but contingent consideration method. So that is mainly applicable in case of financial derivatives like option and future contracts and all. But option pricing method can also be used for risk management. It can also be used for valuation of equity. It can also be used for valuation of enterprise. So these are the method under income approach. And under cost approach, it is a replacement and reproduction method. Summation method is not part of this ICAI valuation standard 103. And now actually, unless we know the basis of value, we cannot arrive at the valuation approach. So first we will go through the basis of value, how a basis of value can be arrived at. But prior to that, any questions on whatever we have covered so far, or can we go ahead?
Sir, I would like to ask, I have come across one word.
Hmm.
That is enterprise value.
Hmm.
So is there any method of enterprise value or in IVS or
Yes.
difference between equity value, enterprise value, like that words are coming in picture?
Yes, yes, yes. So enterprise value is the value of a business entity as a whole, company as a whole. So who are the provider of capital to a company? So that will be lenders of company, that is debt, means non-current debt or current debt, and the capital provided by the owners or promoters of the company. So when we take it together, it is enterprise value. And when we take only equity portion, that is means cash flow available to the equity shareholder. So that is a value of equity. So there are two different concepts. One is FCFF. So FCFF is free cash flow to firm. So that is cash flow is available to both the creditors and owners of the company, and it is a free cash flow to equity, FCFE. So that cash flow is available only to the equity shareholder. So that will be after reducing this debt portion, that is finance cost and repayment of debt, if any. So that is FCFE. In case of FCFE, cost of equity is taken as the discounting rate. In case of FCFF, that is enterprise value, the WACC or weightage average cost of capital is taken as the basis. What is weightage average cost of capital? So weight of equity in a capital structure, weight or a share of equity in capital structure, multiplied by cost of equity plus cost means weight or share of debt in capital structure multiplied by after tax cost of debt. So that is how WACC or weightage average cost of capital is arrived at. And whenever there are a preferred stake, so that will also be added to these for arriving at the weightage average cost of capital. So that is the differentiation between enterprise value and the value of equity. So any further question, Kamlesh bhai?
No, thanks, sir.
I hope it is clear. So any further questions? Any further questions from the participants, or can we?
Good evening, sir.
Good evening, sir.
Sir, my question is, suppose we have decided that while you valuing a company, we will use market value approach.
Okay.
Sir, my question is, from where to get the comparable data?
So, sir, I have actually given
Yes, sir.
some.
You have shared something. I was not able to note that down.
No,
Could you
that
please
will
repeat?
come now, sir. That will come now.
Okay, okay.
And what are the sources of information that will come now, sir?
Okay,
And
sir.
apart from that, this PPT also I will share with the organizer of this event. And at the end, I will upload it in the chat box also. So you may download it, sir.
Okay, sir. Thank you.
So apart from that, any other questions? So we will move forward. IVS 104, a basis of value. So this basis of value, again, very important. Yes, that is the Surya Narayanji, that is the correct definition or correct meaning of enterprise value. That is total market capitalization plus debt minus cash in hand. So there that will be valid when it is a listed entity. So market capitalization is what? It is number of shares outstanding multiplied by price per share. Now, in case of a listed entity, it will be very easy to get the information relating to market capitalization. But in case of a non-listed entity or a smaller company, that will be very difficult to arrive at. So there, in order to arrive at the market capitalization or the total value of equity, necessarily you will have to follow this cost of equity and DCF approach, sir. So I hope it is clear, sir. Yes, PPT I will definitely share, sir. I will share it with the organizer who will in turn share with each participant. And as I told you at the end, I will upload it in chat box also.
Sir, what about Niti Aayog, sir?
Niti Aayog, sir, you will have to visit the website of Niti Aayog, and if required, I will forward it to the organizer, sir, that report. Hai, sir?
Okay, sir.
No
But
problem.
sir, one question is there. You have asked, told about the alpha unsystematic this thing. risk.
Unsystematic. Alpha
So,
is
sir, you have
relative.
not considered in this your lecture the unsystematic risk because it
Unsystematic.
depends upon sir so many factors which are not seen even. We don't know what are the factors which
So-
cannot be identified easily, sir. That is why that
Yes.
is my question, sir.
So that is the challenge for a valuer, sir. So these systematic risk.
Sir, you told about only systematic, sir, but not about unsystematic, sir.
No, that is also there. If you have seen these particularly, I will take you through these slides, sir.
Yes,
Just
sir.
give me a minute. That is part of survey, sir.
Okay,
Findings
sir.
of this
No,
survey.
sir, I've seen, sir.
Hai, sir, it is
Okay.
there. How
Yes,
it
sir.
is arrived at, hai, sir.
Okay,
And see, it cannot be generalized. It is a company specific. So each assignment it will be different. Beta you can generalize it. Like if I calculate a beta of a Gujarat case, which is a listed entity,
Right, sir.
based on this Nifty 50 index. So in Excel, actually, as you are aware, a slope function is there. So whether you calculate by taking 5-year prices or I calculate, it will be same, hai na, sir?
Right,
Unless you change the basis, like if you go to a Sensex of a BSC, that value will change, hai na, sir? But in case of alpha, what are your judgment and what are my judgment, that will always differ because it is a company specific, hai na,
Right,
sir? So that cannot be generalized, sir.
Right, sir. Right, sir. Okay, sir. Thank you.
है ना? So apart from that, any other question? Please include few example for PM valuers. So sir, actually I consider PM valuation in a way, it is very easy. I am sorry for that, but it is in a way very means less challenging for a PM valuer as compared to this SFA or land and building, because plant and machinery, sir, you will just have physical verification of the asset, and based on that, sir, actually I was employed with the Indian Oil Corporation, and being in finance, actually I was included in many committee, either to actually wherever assets were put for sale second hand, which were not useful. So there actually we were arriving at a valuation means based on certain norms very easily, sir, because by actually having physical inspection of the asset and collecting other information, you may arrive at the estimation. Like, sir, you take example of our second-hand motor car. So in market, there are ample players who just by inspection will give you the value of that motor car, sir. Within a few minutes, they will be able to give a value of that motor car. So in a way, actually, going by the history, operation history of that particular plant and machinery, and after having physical verification of that plant and machinery, we may arrive at the value. Again, I am not telling it is actually non-challenging at all. It will have its own challenges, sir.
Right.
But actually, problem is for specialized machineries.
Which machinery, sir?
Specialized.
Specialized. Very true. Where are rarely available in the market. Very true, sir. Very true.
Comparables are not available.
Yes. Very true. So there actually, you may go by the what cost that a company has incurred and how it is depreciated or book value. And see, again, it is an estimation. So no estimation can be accurate. It will be based on certain presumption and assumption. So that is what the job of a valuer is, sir. So we will move forward because time is less and we have to cover a lot actually. So we have already covered this. So basis of value, again, very important. for any valuation assignment. So basis of value, so fundamental premise on which the reported values are or will be based in some jurisdiction, it is always also known as the standard of value. So it is critical that the basis of value be appropriate to the terms and purpose of the valuation assignment, as a basis of value may influence or dictate a valuer's selection of a method, inputs and assumption, and the ultimate opinion of value. So valuer may be required to use the basis of value that are defined by statute, regulation, private contract or other document, and such basis have to be interpreted and applied accordingly. So here I will like to give one example of CIRP regulation or a liquidation process regulation under IBC. So under a CIRP, actually a registered valuer, he need to ascertain fair value and the liquidation value on the date of commencement of insolvency proceeding. So what is a fair value and what is a liquidation value? So those terms are defined under the CIRP regulation. So once those terms are defined under a statute or under a regulation or under an act, so that will always have a upper hand. So that we have to understand actually, and that is what is mentioned here. So valuer may be required to use the basis of value that are defined by statute or a regulation. Sir, I am audible, ne? Am I audible?
Yes,
May
sir.
I?
Yes, sir.
Yes,
sir.
yes, yes, yes.
Yes, sir.
Okay,
Yes,
okay.
sir.
So Charu madam, you just see your connectivity. Charu madam, you are required to check your connectivity at your end. Okay, okay. So it is critical that basis of value be appropriate to the terms and purpose of purpose of the valuation assignment, as the basis of value may influence or dictate a valuer selection. And this we have already discussed wherever it is defined under the act or law provision. So that will always have a upper hand. And while there are many different bases of value used in valuation, most have certain common element, that is assumed transaction or assumed, like in a CIRP actually, a valuer needs to ascertain liquidation value of a company. So that is assumed transaction because that company is not in liquidation in reality. So that is a assumed transaction, assumed date of transaction. So as I told you under IBC, CIRP, the fair value and liquidation value needs to be ascertained on the ICD, that is insolvency commencement date. So that is again assumed date and assumed parties to the transaction. So who exactly will be the party, prospective buyer of that company under CIRP? So that will be assumed. So that is how actually this is done. And see, there are actually different type of basis of value. So a few basis of value are actually defined and mentioned under IBS. There are other basis of value which are mentioned in the IBS but not defined. And apart from that, there are other types of basis of value. So again, a list of basis of value that is not exhaustive. So a market value, a market rent, equitable value, investment value or work, synergistic value, and a liquidation value. So these six bases of value, these are not only mentioned in the IBS, but these bases of value are also defined in the IBS. So that is very important. What is a market value? So definition of market value is similar to what is given under IFRS 13, IFRS or International Financial Reporting Standard 13, or under this Ind AS 113, which is on a measurement of fair value. More or less definition of market value, which is given under IBS, is also same, because see, IBS and IFRS, they have an tie-up. So whatever important terminologies are used in IFRS, that is International Financial Reporting Standard, more or less same terminology or a meaning is adopted under IBS also. So that we have to remember. So market value, it is nothing but the value exit price at a at a marketplace between two unrelated party, not a related party. So that is what the meaning of market value is. Market rent, it is same as market value, but that market rent is mainly used in case of leasehold property. So there it is used. Equitable value, so that is basically exchange ratio. So that is used in cases of mergers and acquisition or business combination cases. Similarly, this investment value or worth. So investment value is related to a particular entity. So what worth or what value a entity will derive out of a particular investment. So that is the investment value. So we have to remember it is entity specific, it is not market specific. Synergistic value. So synergistic value is in case of a business combination. So value of an asset to the individual entity will always be less than a value of a same asset to a combined entity. So that is applicable in a business combination cases. A liquidation value. So a liquidation value is when assets are sold in a piecemeal basis. So it is not that under a liquidation process regulation, this liquidation value is applicable in all cases, because now, as you are aware, under a liquidation process regulation, there are different type of transactions which are envisaged. One is a sale of firm as a going concern. So previously it was only under CIRP when firm was actually being handed over to another entity as a going concern. But now it is possible under liquidation process regulation also. Then another way of disposal of asset under of a company under liquidation is the slump sale. So what is slump sale? So definition of slump sale is not provided under any of the IPC regulation or under the Companies Act. So what is slump sale? We will have to refer to the meaning given under the Income Tax Act. Or third criteria is business sale. So that is also now possible under liquidation process regulation. So what is a business sale? So we can visualize a company like Reliance. So Reliance is having different types of businesses like telecommunication, retail, petrochemical, oil and gas, refining business. So supposing one of that business is sold, like telecommunication, so that is a business sale. So all these are different modes of disposal under the liquidation process regulations of IBPI. And in all cases, this liquidation value will not be applicable. Liquidation value will be applicable only when assets of a company under a liquidation or under a winding up process, those assets are disposed of in a piecemeal basis. So that is very important. Now this is the meaning which I explained you. So market value is the estimated amount for which an asset or liability should exchange on the valuation date between willing buyer. So more or less this is a fair value. Market rent is also a fair value. So market rent may be used as basis of value when valuing a lease or interest created by a lease. So only in case of leasehold transaction, this market rent is used. Similarly, equitable value, so that is a price for a transfer. So that is nothing but exchange ratio. Investment value, as I told you, it is entity specific. Synergistic value, so value a combined unit, combined business entity will be more as compared to individual business entity. Liquidation value, so is the amount that would be realized when an asset or group of asset are sold on a piecemeal basis, and liquidation value should take into account the cost of getting the asset into sellable condition, as well as those for a disposal activity. So this is very important in arriving at a liquidation value. So apart from that, as I told you, there are other bases of value. So these bases of value are mentioned in the IBS but not defined. So fair value as per IFRS or Indian accounting standard, a fair market value, a definition of which is provided by OECD. So what is OECD? It is Organization for Economic Cooperation and Development. So these organization has also provided the meaning of a fair market value, and that fair market value as per a definition or a meaning provided by OECD, that is largely used in litigation cases. It is recognized by the court of law world over, globally. So that is very important, fair market value as per OECD. Then a fair market value as per US IRS. So what is IRS? So in India, we know as Income Tax Department. In USA, it is IRS. IRS is Internal Revenue Service. So in Income Tax Department, in a way of USA, has also provided the meaning of a fair market value. So as a valuer, we need to be familiar with the different meaning provided by the different documents of a same terminology. So if we go through it, it will always be helpful. And then a legal value, so that is provided in Model Business Corporation Act, and another is this Canadian case law on Manning versus Harris Steel Group. So we can appreciate the importance of this particular case law because it is mentioned in the IBS. Again, all these documents are available freely on the internet. So if you are interested, you may download it because a case law will provide always a very meaningful analysis of a terminology. So that is a Canadian case law. And this is the meaning of various bases of value as per this OECD, as per this United States tax purposes. That is Regulation 20 by 2031 by 1. So that is around a 20 to 25 page document. So if you are interested, again, I suggest you may download it. It is freely available on the website. And these fair value or legal and statutory. So these are very important. Supreme Court of British Columbia in Canada. So that issued a ruling, Manning versus Harris Steel Group, that stated thus a fair value is one which is just and equitable. That terminology contains within itself the concept of adequate compensation, indemnity, consistent with the requirements of justice and equity. So if we keep these definition in our consideration while taking up any valuation assignment, probably we will be able to give accurate estimation because it is mentioning that consistent with the requirement of justice and equity. So once we keep that in mind, so probably our estimation may not turn out to be inaccurate at a later date. So as this reminds me, actually, whenever we are stuck up in our personal life, what we do, we refer to the holy books for the guidance. So in our evaluation assignment also, whenever we are stuck up at a particular point, definitely we will get the guidance from this valuation standard and other documents related to that. So we should make it a point to refer to that actually. And these are the further guidance on basis of value. This valuer must choose a relevant basis of value according to terms and purpose of the valuation assignment. And valuer's choice of a basis of value should consider instruction and input received from the client. So all these are given and part of IBS 104. And this is the premise of value. After actually basis of value, next job is to have a premise of value. So premise of value, it is assumed use. So that is highest and best use, current use or existing use, or orderly liquidation, or a forced sale. So these are a basis of premise of a value. And these are the entity specific consideration. So apart from a basis of value, apart from premise of value, before arriving or before deciding on the valuation approach, the valuer needs to consider these entity specific factors also, like additional value or reduction in value derived from the creation of a portfolio of similar asset, unique synergy, legal right, tax benefit. So all these are entity specific. Now, actually, these are the classification of valuation method. So as per a different financial statement wise, so balance sheet, we can arrive at liquidation value or replacement value or book value or adjusted book value or substantial value. Income statement, we can arrive at price to equity ratio or a PER, or a sales or price to PER to EBITDA, or enterprise value to EBITDA and other multiples. And cash flow, we can arrive at FCFF, FCFM, dividend discount model, then adjusted present value, value creation, economic value added and all, and options. All these are a classification of valuation method. So these are the important consideration. So while actually selecting the market approach as a basis, so these are the important consideration. Maximize the use of observable inputs, a price or a cost for a similar or identical asset in active market, actual cash flow generated, and minimize the use of unobservable inputs, estimated price cost for unidentical asset, and projected cash flow. Now we can discuss these for actually in detail, but time is less, so we will skip that. So these are the important consideration, and these are the key factors in a selection of valuation approach. So nature of asset to be valued, availability of adequate inputs and information, and its reliability, strength and weakness of each valuation approach and method, valuation approach method considered by market participants, consistent with the objective of using a valuation technique according to a valuation standard. So these are the key factors in a selection of valuation approach. Moving forward, I would like to highlight this particular circular. A question comes whether to actually select one single approach or a multiple approach in valuation. So these particular circular that is issued by NSC and BSC. So this is applicable for a listed entity, number one. And number two, it is applicable in cases of a business combination or other arrangement to arrive at the exchange ratio. So there actually this particular circular is used. So there actually valuer need to do valuation as per all three approaches. Then he is required to give a weight to value arrive at through each approach. and based on that, he will arrive at the weightage average exchange ratio. So actually, whenever a question comes whether to select a single approach or multiple approach, so valuer should invariably take into consideration whether any statutory guidance or whether any regulatory requirement is prescribed for that or not. So that is again a very important. This is just one example. Now a question came for the participant, which where to get the data in case of a market approach. So these are the data source for a private company transaction. So this is just an example. So several publications collect and decimate information on transaction. So most publication make their database accessible on internet for a fee on a per use basis or annual subscription basis. So if we intend to get data relating to private company transaction, we have we can have option of subscribing to these types of data sources. So like BVA, it is one data source, then beach forms, Reuters, and there are many more. So this is just an example. If need be, we can make use of that. Now, a basic financial indicator. So size measure. So these include sales, profit, total asset, market capitalization, employees, and total invested capital. Even how size may affect value, at least one and maybe all of those should be included. So this is actually useful when we are doing a valuation as per a relative valuation approach, that is a market approach. So what areas to be considered? So that is listed here. Then historical growth rate, consider growth rate in sales, profit, asset or equity. Then activity or and other ratios. So examples are the total asset and inventory turnover ratio, depending on the type of business being analyzed, other ratio may be considered. And measures of profitability. So it is EBITDA that is used widely actually. So that is nothing but earning before interest, tax, depreciation and amortization, or earning before interest and tax, or net income, or the cash flow. Profit margin. So again, it is current level of profit is probably less important than the ratio of profit relative to some base item, usually sales, asset, or the equity. So that is again a very important. So these are just indicators, or this is just a basic guidance which I am trying to provide. So capital structure, so it is essential to use some measure derived from the current capital structure. The most common measure are the values of outstanding total debt, preferred stock, and the market value of common equity, since the book value of equity generally has a very little to do with how stock investor view their relative position with a company. And other measure, so this will be a function of what is important in the industry in which a subject company operates. So again, this reminds me actually a classification of a sector in which a company is operating, and classification of industry in which that company falls. So that is again a very important consideration. And again, on internet, if you are interested, sector classification, methods of sector classification is available. So as you may be aware, worldwide 11 sectors are recognized. One of them, for example, is energy sector. So under those 11 sector, there are 100 plus industries which are recognized, and 100 plus industry again, there are sub-industries. So that type of classification it is available. There are institutions who are engaged in making such classification. So you may download that. Again, that is freely available on the internet. Now, what is the appropriate multiple? So a number of earning multiples are commonly used, including price earning or enterprise value to EBITDA, or enterprise value to EBIT, or enterprise value to EBITDA. So particular multiple use should be appropriate for the business being valued. And in general, actually, because of the key role of financial structuring in private equity, multiples should be used to derive an enterprise value for the underlying business. So therefore, where a price earning multiple is used, it should generally be applied to a taxed EBIT figure after deducting finance cost relating to working capital, or to assess acquired or leased using asset finance, rather than to actual after tax profit. So this is actually a methodology. If we go into detail of that, that will take time. So you may analyze that. And adopting multiple, again, this guidance is provided by definition. Earning multiples have as their numerator and value as their denominator, and earning a figure. So a denominator can be earning figure for any specified period of time, and multiples are often defined as historical, current, or forecast to indicate earning use. So this is again a methodological. Since we have less time, we will skip this. This again a PPT. I will upload it. So we will now move to valuation approaches and method. So what I have done, I have taken guidance from IBS itself. I have highlighted certain important para from IBS 105. So according to para 10.4 and 10.5, a valuer are not required to use more than one method for the valuation of an asset. So we come across a question, how many approach to be used. So according to IBS, valuer need not employ more than one method for the valuation of asset, particularly when the valuer has a high degree of confidence in accuracy and reliability of a single method, given the facts and circumstances of the valuation engagement. So this is ideal situation which we may not come across in a majority of the cases, but because in majority of cases, like supposing we are getting a valuation assignment under IBC, so in majority of cases that resolution professional, he will inform us documents are not available. And so under that, actually, a valuer may not be confident about the estimate which he is arrived at. So there will be need to use more than one or multiple valuation method or multiple valuation approaches. But whenever actually valuer is confident about his valuation estimation, so there is no need of adopting more than one valuation method or one valuation approach. So that is what is mentioned here. A valuer are not required to use more than one method for the valuation of an asset, particularly when the valuer has a high degree of confidence in accuracy and reliability of a single method, given the facts and circumstances of the valuation engagement. However, a valuer should consider the use of multiple approaches and methods, and more than one valuation approach or method should be considered and may be used to arrive at indication of value, particularly when there are insufficient factual or observable inputs for a single method to produce a reliable conclusion. So that is what I have discussed. Whenever valuer is confident, use one valuation method and approach. Whenever a valuer is not confident, use multiple methods under a single valuation approach, or a multiple valuation approach and multiple valuation method, whichever is applicable. So moving forward, this is para 10.5 and 10.6 of IVS 105. So while these standard include a discussion of certain methods within the cost, market, and income approach, it does not provide a comprehensive list of all possible methods. So that is what I informed you in the beginning. Valuation approaches, there are 3 valuation approaches which are recognized world over. But there can be a number of methods under those valuation approaches. Some of them are mentioned under IVS, but that list is not the exhaustive list. That is what is mentioned here. And so while this standard includes a discussion of certain methods within the cost, market, and income approaches, it does not provide a comprehensive list of all possible methods that may be appropriate. So it is the valuer's responsibility, again, very big responsibility on valuer to choose the appropriate method for each valuation engagement, and compliance with IVS may require the valuer to use a method not defined or mentioned in the IVS. So even if a method which is not defined or mentioned in the IVS, that method is used by the valuer, so that will be regarded as the IVS compliant valuation report. When a different approaches and or method result in a widely divergent indication of value, so valuer should perform procedure to understand why value indication differ, as it is generally not appropriate to simply weight 2 or more divergent indication of value. So in such case, a valuer should consider reconsider the guidance of para 10.3 to determine whether one of the approaches or method provides a better or a more reliable indication of value. So it is not that whenever 2 methods are used or multiple methods are used and a different valuation estimation are arrived at, and a valuer simply will do or make the average of that, and he will give a range of value. So that is not proper. That is what mentioned here. So he will have to investigate the reasons for a different estimate as per a different valuation approach or a different valuation method. So that is imperative on the part of a registered valuer. So this is again para 10.7 and 8. So valuer should maximize the use of relevant observable market information in all 3 approaches. So it is not that observable market information is relevant only in case of market approach. In case of a cost approach also, and in case of income approach also, the valuer needs to take market information into consideration, which is observable input. So that the use of observable input should be maximized. So that is what guidance is as per this paragraph. And this regardless of sources of inputs and assumption used in evaluation, a valuer must perform appropriate analysis to evaluate those inputs and assumption and their appropriateness for the evaluation purpose. So that is again a very important. And although no one approach or method is applicable in all circumstances, price information from an active market is generally considered to be the strongest evidence of value. So that is how a market approach is taken into consideration for more than 80% of the cases, because that is always considered to be the most appropriate method. Price prevailing in the market will always have upper hand as compared to the estimation arrived at by the valuer. So that is again a very important guidance. And some basis of value may prohibit a valuer from making subjective adjustment to price information from an active market. So price information from an inactive market may still good evidence of value, but subjective adjustment may be needed. So what is active market? What is inactive market? So a meaning of that is again provided under the SEBI regulation. So we should search for a meaning of important terminology wherever it is not provided under same document. Like under IBS, actually, what is the meaning of active market? What is the meaning of inactive market? So that meaning is not specified in the IBS. So we should look for other document. So IBS, what is active market and what is inactive market? A meaning of that is provided under the SEBI regulations. Now, para 10.10, 9 and 10. So in certain circumstances, the valuer and the client may agree on the valuation approaches, method and procedure. The valuer will use or extend of a procedure, the valuer will perform. So depending on the limitation based on the valuer, procedure performed, such circumstances may result in a valuation that is not IVS compliant. So that is very important. A client may enforce any condition, you do a valuation according to income approach only or according to DCF only. But if valuer fails to take into consideration estimate as per the market approach, so that report will not be regarded as IVS compliant report. So once it is not IVS compliant report, so that valuation report will always be open for a challenge at a later date. So it is very imperative that a valuer try to issue IVS compliant valuation report. Now, this reminds me actually, the guidance is to issue IVS compliant valuation report. But when we look at the current trend in a market relating to professional charges that are paid to a valuer, so that is very less actually, particularly in IBC cases. So if we have to give IVS compliant report, so that will necessitate a detailed scrutiny, and it will involve cost also. But the remuneration or the professional fees that is paid to a valuer, it is very less as compared to actual efforts that valuer needs to be put in. So like actually in the recent past, actually, IBBI or Insolvency and Bankruptcy Board of India, it took lead in fixing a certain minimum professional charges for insolvency professional. So same way for a registered valuer also, a certain minimum criteria for a professional fees, it needs to be fixed by the regulator, that authority, which in this case is the same IBBI. So that is important. So I thought I will highlight that. Now, actually, this specific guidance is there relating to all three approaches. But if we go into detail of that, so that is a very detailed one. So time is actually we are arriving at the closing time of this session. So I will highlight these important paragraphs only. So EBITDA multiple, as we are aware, EBITDA multiple is the comparison of enterprise value and earning before interest, taxes, depreciation, and amortization. So there actually this enterprise value, it is market capitalization plus total debt minus cash. So that that is pointed out or highlighted by a participant also, but that is applicable wherever listed entity is there. And EV or enterprise value divided by EBITDA. So EBITDA enterprise multiple. So it is enterprise value divided by EBITDA. Earning multiple. So price equity ratio, price earning ratio. So that in our personal life also, before investing in a equity, we consider this P ratio of a particular share. So that is a general ratio, that is earning multiple. A PE ratio, price earning ratio. That is it is also sometimes known as the price multiple or earning multiple. So it is ratio which is calculated by dividing market value or price per share by the EPS or earning per share. And the most common measure of valuation using a multiple accounting earning. Revenue multiple, so it compares a company's stock price with its revenues, also known as price to sales ratio. Now actually a book value multiple, so it is used to compare a stock's market value to its book value. So it is the ratio of market price of a company's share over its book value. So all these we are familiar. If we go into a detail of that, then it will take time actually. So I will forward this detailed PPT to the organizer of this particular session, and I have actually given information relating to all. So with this actually I will end my today's session, and means I am open for questions if any on whatever topic we have covered today. And in the meantime, what I will do, I will try to upload these PPT in the chat box so that you can download that. So just give me a minute. I will upload this in the chat box. Thank you, Sanjeev ji, for your kind words, sir. So what I have done, I have uploaded this PPT in the chat box. So if you are interested, you find it interesting, you may download that. Rajiv ji, thank you very much, sir, for your kind words. Rao ji, thank you very much, sir, for your kind words. And any questions on whatever we have covered today, sir? Yeah. So if no questions, then we may end the session, sir. Thank you each one of you for your kind words, and I thank each one of you for your attention also. Thank you very much, sir.
Participants, no questions. So shall we end?
Yes, please.
Yes. So time to thank everyone. Thank you, Chatwani sir, for covering the topic very nicely and delivering a very elegant and comprehensive lecture. And thank you for associating with us. Thank you, participants, for participating in this CEP. Please share your feedback As RVO, our duty is to promote valuation profession and also keep the knowledge level of our valuer members at very high level. So kindly help us. Suggest topics for our future CEPs and also associate with us for our future CEPs. Thank you very much. Thank you, Kajal.
Thank you, sir.
Thank you, sir.
Thank you, everyone. Thank you.